Alphabet just delivered the biggest quarterly profit in corporate history. Earnings per share exploded 294%, revenue jumped 24%, cloud revenue surged 82%. So why did the stock crash 7%? Because behind the record-breaking profit was something investors weren't expecting: negative $5.86 billion in free cash flow. The first negative quarter in Alphabet's public history. So which Alphabet is real? A cash-printing AI powerhouse or a cash-burning giant? This is Wall Street Holic deep dive into Alphabet, ticker GOOGL, second quarter fiscal 2026 earnings review. Welcome back to Wall Street Holic, where we cut through the hype with data, not opinions. Every conclusion is backed by research, and you can download the full report using the link in the description. As of the 24th of July 2026, Alphabet trades at $319.24, giving it a $3.9 trillion valuation. Straight to the point. Our rating is hold, our 12-month target is $250, and our sentiment score is 6.9 out of 10. Let's break down the quarter, uncover the $99 billion asterisk behind those record profits, examine the balance sheet reset, and answer the only question that matters: is Alphabet still worth buying? This is research and education, not financial advice. Start with the returns, because they are extraordinary. Return on equity of 48.8%, return on invested capital of 33.8%, and even stripping the investment gains out entirely, core return on equity is still 24.9%. Revenue has compounded at 18.3% a year for a decade, with trailing revenue of $445.9 billion, up 24% and accelerating. Then you reach the cash flow block and the mood changes. Free cash flow is the cash left after a company pays its bills and maintains its assets, your salary after rent and the car service, not before. Alphabet's went 24.5, 24.6, 10.1, then negative 5.9. A business earning 33.8% on capital should not be running out of cash. And here is where the trap is set. Alphabet trades on a price-to-earnings ratio of 16 times. A price-to-earnings ratio is the price of $1 of annual profit, so 16 times means 16 years of earnings to buy the whole thing. Cheap for something growing 24%. Except that uses GAAP earnings of $19.93. Here is the most crucial point. Strip out the paper gains and core earnings are $10.16. And the multiple is 31.4 times. Same company, twice the price. The balance sheet is still fortress grade. But look at the capital return block. Buyback run rate, 0. Common stock issued, $30.5 billion. For the first time in its listed history, Alphabet is handing shares out rather than buying them back. So, the verdict up front. We rate GOOGL a hold with a 12-month target of $250, roughly 22% below today's price. And be clear about why, because this is not a bear case on the business. The business is accelerating. Revenue rose 24% to $119.8 billion, the 12th straight double-digit quarter and the fastest growth since 2021. Operating income rose 30%, margin up 2 points to 34%. Cloud grew 82%. Its operating income tripled. Its margin went from 20.7% to 35.6%. Backlog, $514 billion. That is a magnificent quarter. The franchise deserves a premium, and the market has already paid one. But the bottom line is where this stops being simple. 4 numbers frame the quarter. Revenue of $119.8 billion, up 24% and up 23% in constant currency, so this is no weak dollar illusion. Operating income of $40.77 billion at a 34% margin. Operating margin is the share of every revenue dollar left after running the business, and Alphabet's rose 2 points while absorbing a 72% jump in AI research spend. That is real leverage, not cost cutting. Core earnings per share of $2.85, and free cash flow of negative $5.86 billion. Underneath, search at $63.27 billion, YouTube ads, $11.06 billion, cloud at $24.77 billion. Every line on this slide argues for buying the stock, so let's find out why the bottom line does not. This is the most important slide in the deck. Of that record, $9.11 of earnings per share, $6.26, 69% of it, came from one line, a $99 billion unrealized gain on equity securities. Two positions did all of it. SpaceX went public in June at roughly a $1.77 trillion valuation. And Alphabet's stake was marked at $94.1 billion against an original investment of about $900 million. Anthropic went from around $350 billion to about $965 billion. Extraordinary investing, genuinely, but unrealized means nobody sold anything, and roughly $80 billion of that SpaceX stake sits under sale restrictions. Alphabet booked a $99 billion paper gain and raised $49.6 billion of real equity in the very same quarter, which tells you to go looking in the footnotes. 1. The buyback is switched off, not tapered, off. 0 repurchases in the first quarter and 0 in the second, against $28.31 billion in the first half of 2025. 2. A first in Alphabet's history. It issued equity. $30.5 billion of stock plus $19.1 billion of preferred, and share count went from 12.09 billion shares to 12.23 billion shares in 6 months. That is dilution. Your slice of the same pie gets thinner, the exact opposite of what a buyback does. 3. Preferred dividends now sit on the income statement, about $1.19 billion a year, ranking ahead of you. 4. Inventory up 310% to $9.99 billion of TPU hardware. 5. A $21.9 billion tax charge nobody paid in cash. 5 down, 5 to go, and the next one rewrites Alphabet's credit story. 6. Long-term debt more than doubled in 6 months, from $46.55 billion to $98.17 billion, and quarterly interest expense went from $261 million to $1.28 billion. That AAA balance sheet is being levered up deliberately. 7. $33.7 billion of acquisitions ran through the cash flow statement, and amortizing those intangibles is a permanent drag on margins. 8. Google network revenue is shrinking, the only declining line in the business. 9. The unallocated AI research bill jumped 72% to a $5.79 billion operating loss, and it sits outside every segment margin anyone quotes at you. 10. The mix pivoted hard to the US, now 50.8% of revenue. 10 findings, 1 theme, so let's set the good against the bad and weigh them honestly. Positives first, and they are real. A backlog of $514 billion, up more than $50 billion sequentially, with over half expected to convert inside 24 months. Backlog is contracted work not yet delivered, revenue signed but not yet earned, and at that size, it is a forward order book almost nobody can match. Search is expanding, not eroding, up 17% on record query levels. Gemini at 950 million monthly users from 750 million. Now the negatives. The first negative free cash flow quarter ever. Capital expenditure of $44.92 billion, exceeding operating cash flow of $39.07 billion. Guidance raised again. Buybacks at 0. Leverage climbing and an €890 million fine. The positives are all about the business. The negatives are almost all about how it is being paid for. So, how is it paid for? The funding lines tell you everything. $30.5 billion in from common stock, $19.06 billion from preferred, $56.23 billion net from debt, nothing spent on repurchases, and $80.6 billion straight out into property and equipment. For a decade, Alphabet funded everything internally and returned the surplus. In 6 months, it took $86.3 billion from financing markets and returned $5.2 billion. There is no solvency question. Net cash, meaning cash minus debt, is still around $144.3 billion. But that cash pile now includes about $94 billion of SpaceX stock, and that is not spendable money. The flexibility premium the market paid for over a decade is precisely what is now being spent. Sit with the buyback a moment because it is the cleanest signal in the release. About $27 billion repurchased on a trailing basis, all of it in the second half of 2025, and a run rate today of 0. Against that sits $30.5 billion of stock issued in June alone, so the net shareholder yield is negative. Here is the honest framing. Capital that used to shrink the share count is now buying data centers and chips. That is defensible if the return on the new capital beats the cost of it. Return on invested capital against a 9.0% cost of capital. Above 9%, spending creates value. Below it, it destroys value, however impressive the revenue looks. The entire bull case reduces to that one test, so let's see what the demand picture says about it. Demand, competition, regulation. Cloud is supply constrained, not demand constrained. The CFO said demand continues to outpace capacity after 3 years of expansion. External TPU sales began at small scale, with the bulk of that revenue landing in 2027. Advertising is intact, with AI overviews expanding queries rather than replacing them, and cloud's 82% is running well ahead of AWS and Azure. This is what a moat looks like in practice. Owning the silicon, the data centers, the models, and the distribution, so a rival cannot outspend one layer and catch up. But it is expensive, and Alphabet is now a customer too, paying roughly $920 million a month to SpaceX. Add a 60-day remedy window and daily penalties of up to 5% of global revenue, and the bill for that moat is what management had to address. Alphabet gives no formal revenue or earnings guidance, so precision matters here. What management explicitly said, fiscal 2026 capital expenditure of $195 to $205 billion, raised from $180 to $190 billion. Fiscal 2027 capital expenditure up significantly, no range given. Third quarter cloud margin pressured by the capacity bridge. Third quarter search comparisons tougher, no further equity raises planned. Now, our estimates, labeled as ours, fiscal 2026 revenue around $490 billion and free cash flow of roughly negative $37 billion. Fiscal 2027 revenue around $583 billion. Core earnings per share of $12.31. Free cash flow negative $41 billion, the trough year. First cash flow positive year, fiscal 2029. Meanwhile, street targets sit around $414 to $430 because they capitalize those equity marks. We are not disagreeing with the street about the company. We are disagreeing about what counts as earnings. 10 years in one table. Revenue from $490 billion to $1.33 trillion by fiscal 2035, decelerating from 21.6% growth to 7.5% as cloud matures. EBITDA margin expanding from 40.8% to 50%. Capital expenditure stepping up to $245 billion next year, then flattening, which takes it from 40.8% of revenue down to 22.5%. But watch the depreciation column, because that is the swing factor, from $36 billion to $218 billion, as roughly $1.3 trillion of cumulative capital expenditure wears out. That is the catch with EBITDA. It is earnings before depreciation, so it flatters any company spending heavily on physical assets by ignoring the cost of those assets aging. Here, that depreciation holds operating margin near 30 to 34%, even as EBITDA margin touches 50%, which is why we value this on cash instead. Here is the method and the one longer explanation in this video, because everything hangs on it. A discounted cash flow model does exactly one thing. It prices tomorrow's cash in today's money. Picture someone offering you $100 a year from now. You would not pay $100 for it today. Partly because your money could have been earning a return meanwhile, partly because the promise might not be kept. So maybe you pay $91. That discount is the cost of capital, and here it is, 9.0%, built from a 4.2% risk-free rate, a 4.75% equity risk premium, and a beta of 1.10. Do that for every year to fiscal 2035, then add a terminal value for everything beyond. which here is $2.483 trillion of the $2.897 trillion enterprise value. Add the cash and investments, subtract the debt, and you land on $250. When 86% of your answer lives in the terminal value, you already know which assumption to stress next. $234 low, $250 mid, $270 high, built by moving terminal growth half a point either side of 3.0%. And it is a range rather than a single number on purpose. A fair value estimate is the output of assumptions reasonable people dispute, so anyone handing you one precise figure is hiding the uncertainty, not removing it. The band is narrow because the discount rate dominates. Move that instead, and it swings hard. A cost of capital of 8.5% lifts the mid case to roughly $278, while 9.5% takes it to about $226. And here is the most useful line on the slide. To justify $319.24, you need terminal capital expenditure of about $117 billion against $218 billion of depreciation. That is not a steady state, unless the backlog converts faster and capital expenditure normalizes by fiscal 2028, in which case the honest answer is well north of $300. Target $250, implied downside 21.7%. Rating, hold, own it, do not chase it. Now, both sides, equally seriously. What pushes us to the low case at $234? A second capital expenditure raise without matching cloud acceleration, cloud margin falling below 30%, backlog growth stalling, a markdown on SpaceX or Anthropic, or EU remedy failure triggering those daily penalties. What pushes us to $270 and above? Fiscal 2027 capital expenditure guided below $250 billion, TPU sales converting at scale, cloud holding a 35% plus margin through the capacity bridge, a resumed buyback or free cash flow turning positive early. We stop short of sell because those assumptions are genuinely two-sided. We are not arguing the business is deteriorating, only that the price already assumes it wins. 5 weighted pillars: earnings, quality, and trend. 7.0, outstanding growth marked down because 69% of headline earnings per share is non-cash. Balance sheet and cash, 7.0. Guidance versus expectations, 6.0. Moat and positioning, 9.5, the highest score by a distance. Valuation versus risk, 4.0, the lowest, because 31.4 times core earnings leaves no margin of safety. Total, 6.9, which also tells you who this suits. If your horizon runs past fiscal 2029, when our model turns cash flow positive, that 9.5 is what you are buying. If you need cash returns or a margin of safety today, the 4.0 is what you are getting. Matching a stock to your own timeline matters more than whether the company is great, and this timeline has dates attached. Every number is fully sourced. The data comes from Alphabet's 22nd of July 2026, Form 8K, and earnings call. The analysis, valuation, and models are ours. Our conclusion: Alphabet is executing better than ever, but today's price already assumes that success. Our verdict: hold. This is research, not financial advice. Check live data, do your own research, and remember, every valuation depends on its assumptions. At Wall Street Holic, we don't chase headlines, we follow the evidence. Download the full research using the link below. If you value data over hype, hit subscribe, like, and share. Every deep dive is driven by this community. Keep an eye on 2 key dates: the 60-day remedy deadline from the 23rd of July and the 22-cent dividend on the 14th of September 2026. See you in the next one.